A new report from the nation's central bank shows more Korean companies are struggling to pay back interest on their debt. KIM Hye-sung help us look beyond the numbers.
1 out of 3 Korean firms were unable to make interest payments on their debt using just their earnings. According to the Bank of Korea's Financial Stability report Thursday, out of the 21,000 Korean firms surveyed, 32% had an interest coverage ratio below 1, the highest figure since 2010. The interest coverage ratio is calculated by dividing a company's operating profit by its interest expenses. A ratio below 1 means the firm's interest payment obligations are higher than its reported earnings over the cited period. Around 24% of large-sized companies had an interest coverage ratio below 1, while 34% of small and mid-sized firms had a ratio that fell short of that threshold. 14% of all companies were classified as zombie firms, unable to meet debt obligations with their earnings for 3 straight years. By sector, shipbuilding, autos, lodging, and dining saw a high proportion of companies with an interest coverage ratio below 1. The central bank attributed this to falling corporate profits and higher borrowing costs that were seen last year. It added that if business conditions deteriorate amid the escalating U.S.-China trade spat, those with an interest coverage ratio below 1 could surpass 37%. As for household debt, the pace of debt growth slowed to around 5% on year, with total debt amounting to $1.3 trillion at the end of the first quarter. But the ratio of household debt to disposable income was seen at 158% as of the end of March, up nearly 2 percentage points compared to a year ago. That means household debt grew at a faster pace than household income, a serious concern for Korean families and their financial health. Kim Hye-sung, Arirang News.